Great. We've got a star-studded panel, and whilst we wait for Ashish and Rajesh, I thought, I will start off with requesting our panelists to just quickly introduce their funds, their fund strategy, what is it that they do. So we'll start with Visa.
Thanks, Vivek, and thanks, Rajat and team. I think it's fantastic to be at the IBCA panel here. So my name is Visa Lakshi. You can call me Visa. We manage a sector-specialized healthcare and life sciences private equity fund called Tata Capital Healthcare Fund Platform. We are currently in our Fund 2 vintage. Across the two funds, we've raised about $200 million. And some of the primary tenets has essentially been growth capital investing anywhere between $5 to $20 million. We've done so far about 20 transactions, about 7 exits so far. Essentially a very, very ESG and impact-focused investor, and most importantly, about 65% of the deals that we have done has been through our own proprietary sourcing and origination that we have done. And we call ourselves as a capital plus partner, very active investing approach, and investing across the two core themes of domestic consumption and healthcare competency. So that's about us. Thank you.
Hi everyone, my name is Uday Dhawan. I am with Forma Capital. We spun off from Standard Chartered Bank in 2019, and today we are a mid-market private equity firm which is focused on Asia. We manage roughly $4 billion in capital. Over our investing history as a platform, we have made about 100 investments, we've done 60 exits, and we've returned more than $7 billion of capital to our LPs. As far as India is concerned, we've been investing in India for 22 years. We are amongst the oldest PE firms investing in India. As a fund, we typically do deals anywhere between $30 to $50 million. We invest across sectors focused on consumer, financial services, healthcare, and technology. And our approach is, when we look at minority deals, we want to be a significant shareholder on the cap table. And ideally, we like to be the largest shareholder outside the founder, and if possible, the only shareholder. Thanks.
I'm Srinath from Oman India Joint Investment Fund. We are a growth private equity platform sponsored by SBI and Oman Investment Authority. We've been in the business now for 14 years. We've done 2 funds, 19 investments, 16 exits, and 17 partial exits. We have definitely, on the liquidity and exit side, I think we have performed quite well. So I'm very happy to be on this panel and share the excitement. We do generally minority investments between $10 to $30 million, but we are pretty active in our portfolio companies to help them with the type of challenges they may meet, and try to help them grow and bring them to a liquidity stage and achieve that. Thank you.
Hi everyone, a lot of familiar faces in the audience. Thank you for coming here today. I'm Niren Shah. I am Managing Director and Head of Norwest India. Norwest is a 60-year-old fund headquartered in California. We're one fund. Our funds under management is AUM is about $15 billion. We raise a fund every 2 years of about $3 billion. Decent chunk comes to India. I think outside of the US, India is by far our largest geography. In India, we deploy approximately $250 to $300 billion a year. And we do that more as mid-market private equity or late-stage venture. So our typical ticket sizes can be anywhere between $30 million to $100 million. We've exited more than about 28 companies. We've taken 8 companies public. We've got another 3 this year, or another 4 next year. And we're very excited with the prospect of being in India. And we continue to sort of expand our team, expand the deployment, and sort of very bullish on the outlook of India.
So they were just looking for a good-looking Sardar guy to come off the street and join the panel, so I raised my hand. Huh? There's one more. Acha, there's one more. My name is Mohanjeet Jolly. I'm one of the co-founders and partners at Iron Pillar. We're a tech growth fund, investing in companies that are building from India for India and the world. So from India for the world is really the thesis. We're in our 9th year. We actually just celebrated our 9th anniversary last month. About $500 million, so 500 million under management. We're very, very different in that we're really the only fund of our ilk that has presence in India, the Middle East, and I'm actually based in Silicon Valley. So looking forward to this panel discussion. And again, one other thing I should mention is we take a private equity-esque approach to investing. So with a lot of sort of hands-on value addition, and that's part of the reason we have presence in different parts of the world.
Great, thank you so much. Now I'll take a quick 60 seconds to set the context in terms of where we are as far as exits are concerned. We had a fantastic year for exits in 21. Everybody was drunk on easy money, valuations were sky high, people were buying, life was great. 22, massive drop. 23 began to get up further. 24, even better. The capital markets have been lubricating the pathways of exits for private equity funds, and why not so? It's been a great year in 24 where total amount of exits crossed $26 billion. This chart that you will see tells you that almost 48% came from open market exits. This is wherein either the funds had pipe transactions or their portfolio companies had IPO'd a year ago, 2 years ago, and then with the markets going up as the lock-ins eased, the funds were gradually exiting. The depth of the Indian capital markets, the increasing depth, the large block trades that can happen now with minimal discount, we've come a long way from what it used to be in the pre-COVID days, when it was virtually very, very difficult for a fund that owned, say, a majority stake in a listed company. You take it to IPO, and then when the company is listed, you own over 50%, and you bring it down. It used to take a long time. It's no longer so. So the capital market, open market exits along with IPOs, we've had 40 PE-VC-backed IPOs in 24, right? And this is a breakup across sectors. As you can see, financial services, technology, e-commerce, these are the sectors that have clocked the maximum exits in this year. It's no surprise. These are the sectors that get most of the money as far as pure play private equity is concerned. So just a bit of a context in terms of the value and the volume of transactions that we have seen. And I'll jump straight into questions. Naren, let me start with you. Clearly public markets have become such a large part of the exit story, right? Now, you mentioned you've had in Norwest significant number of IPOs, some more in the pipeline. So can you share with us when Norwest is making the investment and when you underwrite what your exit thesis would be, given the way capital markets have come to the fore, how are you approaching this when you make new transactions, when you make new bets?
So I think that's been very critical and a very important part of our strategy. In fact, somewhere around 2017, our entire strategy changed because we found exits are very different in India compared to the US. So one big difference is that in India, you don't get that many strategic exits. You do get some of the very large buyout private equity exits, IT services, pharma. But most of the exits you get, like, you don't get the Googles coming and paying a couple of $1 billion. And I mean, the US, even if a company in the startup world doesn't do too well, somebody might pay 200 million, 500 million. Doesn't happen in India, right? So what we realized very quickly, actually took us a while to realize that exits in India are largely going to come from a very vibrant public market. And the market is getting deeper and deeper and more vibrant. So our entire strategy has changed around 2017 to find those companies which are IPOable. And that's very different. You have to find a founder who is, very, very excited about going IPO, right? She needs to be building a company which has got sort of the right management team, because it has to sort of be robust enough to take on an IPO and sort of be there for 10 years. the corporate governance and the commitment to that, right? So like very early in, we'll bring in independent board members, we'll start our sort of playbook of rolling out the whole IPO piece very early on. So they need to be willing to do that, to get a big four auditor, get some of these things done early on, right? And then of course the market size needs to be large enough, because public companies can't be like $600 million, right? You want to make sure you go IPO around $1 billion mark if you want some liquidity. So the entire thesis of what you're going to invest in, right? Globally, we don't invest, for instance, in industrials. This is a very large part of our thesis now, because when you look at India, we look at what companies will go public, right? I mean, it's going to be including manufacturing, and it includes financial services, it includes a lot of things which are just beyond what our initial mandate was. So I actually feel that India has a very robust, if you go to Southeast Asia, go to some of the other countries, they don't have an IPO market of any standing. I think this is a significant differentiator. I think markets will go up and down. Today, I think they're down, or maybe they're up, I don't know. But if you build great companies with robust corporate governance, with some amazing founders who are there for the long run, and you're willing to go public, I think this market will reward you very handsomely.
Thanks, Naren. So Visa, my next question is to you. On this panel, you're the only one who's running a sector thematic fund focused on opportunities in pharma, life sciences, and healthcare. And if you've seen, the data cuts that came after the Q3 earnings came out, healthcare has just been the only sector, where you look at the indices where the earnings downgrades haven't happened across large cap, mid cap, small cap. Just a trivia point for the audience. But Visa, my question is that what's your experience been like in the last 12 months when it comes to exits? Have you also looked at being overweight on IPO for the exits in your portfolio, or is it more spread out across strategic, secondary? If you could share your thoughts, that'd be great.
So let me maybe address this in the perspective of investments versus exits, right? From an healthcare, life sciences sector. See, clearly, this is a sector, I think this is one of the top 3 sectors attracting private capital investment, right? We know that healthcare, life sciences is attracting as much as $5.5 billion every year. In fact, compared to the last 10 years where you've seen something like about $39-40 billion, about nearly 40% of that has come in the last 3 years. So this sector is attracting 12% of the total private capital investment pool. But to answer your specific question on exits, I think in the last 3 years, we've seen at least about 17-18% of the exits coming from this particular sector. So clearly, I think there has been a lot of activity from exit. And when I talk of exits, I'm also clubbing some of the private capital M&As that have happened, right? Like, for example, you've seen the Bharat Serum's M&A, acquired by Mankind, or for that matter, some of the pharma companies getting into diagnostics, getting into medical devices, etc. So all that clubbed together. So it has been pretty vibrant. The last 12 months itself, on this particular parameter, it's roughly about close to $5 billion. That's what our statistic tells us. And if you deep dive into that, clearly it's a mix of strategic. Strategic is largely from a pharmaceutical sector standpoint. So you have large M&As happening on the strategic side, and that itself is close to about 40% of the overall exits. But on the healthcare side, it's largely secondary, PE to PE, right? A lot of the transactions that we have seen on healthcare. In fact, practically most of the healthcare transactions that one has seen in the last 12-24 months have been largely on the secondary side. Coming to specifically on IPOs, it's again, I would say, close to on the pharma life sciences. In fact, we've most recently seen one of our Fund 1 portfolio company, a legacy company, Sai Life Sciences, which we exited, that has now seen, I think the next investor has seen great returns coming in through the IPO standpoint. So overall, yes, it's a mix across the three spectrums. Specifically on our portfolio, compared to, say, where we were with respect to our Fund 1 portfolio. In Fund 2 portfolio, we are seeing we are likely to experience at least about 2 to 3, about close to about 30% of our deals coming in, exiting through an IPO or IPO route, right? And these would largely be pharmaceuticals, it could be mix of healthcare services, etc. So that's the way we are positioned.
All right, thank you. Uday, my next question is to you. You mentioned that in the last 12 months, your fund has had 3 IPOs in the portfolio, maybe one coming up, some private deals also in the works. So, the question really is that when you're looking at a portco doing an IPO, how do you size the OFS component? How do you decide on, okay, this much I'll, sell in the OFS and this much I'll keep to ride the upside of the remaining position, keeping in mind price volatility, potential shrinkage of multiples, could also be expansion of multiples depending on where we are in the capital cycle, right? And the value trade-off between, say, doing a secondary deal or a private deal and getting 100% exit in one go versus a slightly slower process of a company going to IPO and then you exiting. So how do you synthesize all these various points in making a particular decision? I know it's on a case, but if you give us some broad brushstrokes that you use, it'll be great.
Yeah, so let's use an example, right, which I can talk about, and I think that'll give you a sense of, how we think about it. So we invested in this company called TBO, which is a travel technology platform, about 5-6 years back. We bought half the company, about 49.9% of the company. So going back to my introductory remarks, as I mentioned, our strategy is to be a meaningful shareholder in the cap table, right? So this question that you're asking becomes even more pronounced if you're holding a large stake, because through an IPO, you may not be able to exit the entire stake in one go. So in this case, we sold about a third of our stake. We brought in General Atlantic and we sold a third of our stake at about 10 times our money, right? But when we were doing that, we felt that the IPO valuations are going to be much richer. But at the same time, we wanted to de-risk, right? Because, when we think about a IPO as an exit, we don't think of that as an investment thesis. We have to think of multiple different exit paths, and you never know which one is going to work out. Even though the markets have become much more deep, you can't rely on it, right? So all we can underwrite is high quality operating performance. And we know that if you're sitting on a quality company, whether it's a secondary buyer, whether it's an IPO market, whether it is a continuation fund, whether it is a promoter, you will get an exit. So in TBO's case, we sold a third to a private equity fund. Then we did an IPO, and in the IPO, we did a pre-IPO at the same price, which was 13 times our money. Then we again put something in the IPO, and then we've sold it post-listing at some 17, 18 times our money, right? So on a blended basis, we've done very well, but the point I'm just trying to give you a sense that you have to think about de-risking, and particularly if you're sitting on a nice money multiple, just take money off the table, right? And not be too greedy about it. And at the same time, we still own about 15% of the company today for upside. So I think it's a fine sort of balance, and it'll depend on situation by situation, but our philosophy is that don't rely on one exit path. Yes, today the markets have looked good and we've IPO'd companies, we've taken a lot of money off the table, but our focus continues to be just driving operating performance. And as long as the quality is good, management is good, the exit will happen. IPOs can give you a nice multiple arbitrage, but if your earnings have grown, you will still get a decent exit.
Great, thanks. Srinath, my next question is to you. You mentioned in some of the notes that you shared that Fund 2 has been investing since 2018, and even pre-COVID, you had invested in certain positions in consumer, auto, FS. Now, and then COVID happened, and then after the COVID, the recoveries happened. Now you've had some listings in place. But when you were putting your investment thesis in, when you were baking, what kind of exit I'll have in all likelihood, in how much time, COVID came, maybe some of those things got delayed. Can you tell us how did this all play out? And how are you able to work with your portfolio companies during these times which were trying and stressful, let me put it that way?
Yeah, when we started investing, I don't think we, as Uday said, we didn't plan on exit just by IPOs. IPO is or prolific IPO is a recent phenomenon. Last time it happened in 2017, and then again I think we have seen in the last 2-3 years. So when we do our investment thesis, we are trying to see what is the earnings growth, and without a multiple expansion, what are we going to make, right? It's another story that in this market, multiple expansion has been fabulous, and we have really benefited from it in exits. But that's what we are thinking, that we need to back but promoters who understand their obligation to find an exit over a reasonable period of time for us. And there I think we've done 5 IPOs in our portfolio of 12 companies. We've done 9 exits so far. We've done full secondary exit and partial secondary exit. So we've experienced the whole set of different type of exits. And also at the time of investing, we were very conscious what we did a lot of commercial diligence, and we also advised the promoter at that point itself what you should look when you're exiting. For example, we have a company which makes transmission systems, right, for IC engines. But after a lot of commercial diligence, we told them by the time you list in 23, you need to at least have 20% of our portfolio into EV, which they took very seriously and made partners, consulting partners in Germany to make an EV gearbox. As a result, they're selling EV gearbox for Tata vehicles, Mahindra vehicles, they export, they are leaders in transfer cases, etc. Right? So that people taking input, if we take consumer companies, we have sat down after we invested, we found that consumer is small consumer companies, it's not straight growth, continuous growth. You have pockets of growth and pockets of flat earnings, right? And it can be pretty stressful because valuation, everybody says consumer companies do attract a lot of good valuation, but then we sat with the promoter and said, look, we need to have another brand launch because we have to cover adjacencies. And that we prevailed on him, and credit to him, he did that. We listed, of course, the company went to 106 PE and we sold our stake. That was quite a attractive PE for us to exit, and the liquidity was also there. So we are open to all. We had a situation where the company said they will do listing, they had filed DRHP, but post our investment changed their mind, and then we had to work with them. It's an MNC. We had to work with them for us to get a good buyback, and we did time it pretty well. We got a good exit. So the whole spectrum, but one thing we have done right is to take money off the table without waiting. Without waiting forever that this will appreciate more, this will appreciate more. I would say that we have done about 7 exits between April 1, 23 to October 24, in which includes 4 IPOs, 1 full secondary, one partial secondary exit. If I just compare and just mark to market those exits to where market is today, I think we are close to $70–80 million up in cash realization. And I don't think you can make up for it in a short while, that kind of a gap, right? So taking money off the table is a discipline, and you will come under criticism from all quarters that you've taken money off the table, but I think it's a good discipline to have. So we've tried to say liquidity first and try to find ourselves in a good monetizing situation.
You know, Srinath and I were having a chat before the panel, and when we were talking about how when you take a company to IPO, and then the multiple that the market gives you depending on where the market is in terms of sentiment could be a crazy multiple. And if it's too good to be true, it's not going to last for long. So, you know, book your profits in because you never know how far it'll go down when it starts going down. Our next question is to Mohanjit. Mohanjit, Iron Pillar, tech growth investor, focused on enterprise and consumer technology businesses. You closed your fund in 22 December, and now I guess a lot of your portfolio companies, Series B, Series C, are still sort of young companies. Now when you and your team look at underwriting the deal and you flesh out what your investment thesis is, what kind of exit you will have, for companies, since you invest a bit so much in the younger days, how do you synthesize all this? How do you figure out what your exits maths can look like on a probability adjusted basis? Because I guess amongst the lot that we have here, you're probably the one who goes in earlier So some thoughts on that would be great for us to understand.
Yeah, look, so from a clarification standpoint, we're actually just at the tail end of closing our latest fund, which is an AIF. And the goal with the latest fund, by the way, is to invest in companies that are sort of 20 million in annualized run rate and beyond. So we've gone a little bit later. But to your question, our last fund, which is the December 22 close, was called Global Cloud Fund, was primarily a SaaS fund. Okay? It was investing in US-based entities that are building product from India, but the markets are primarily North America and Europe. And by the way, when we talk about the blend between consumer and enterprise, Iron Pillar overall leans more enterprise, about 2/3 enterprise, 1/3 consumer. The other interesting piece, I will actually say 3 bullet points. One, we actually have a slightly antithetical distribution compared to most private equity or investor diversification classes, right? So ours is a very concentrated portfolio. Only 8 companies, give or take, per fund. And so currently our active portfolio is 14 companies, 16 overall investments, 2 we've exited through, in one case, a sale to Reliance, another one is a private transaction. Of the remaining 14 companies, 7 are India private limiteds, and the other 7 are US incorporated. In our first fund, of the 8 companies, 2 have exited. Of the 6 remaining, 4 are heading towards IPO, starting with Bluestone in the coming months, right? So coming back to how we think about exits, I'm going to borrow a little bit from Niren. We actually have this sort of bifurcated approach, right? So when we think about US entities, the IPO market is shut, right? And the other thing is you have to be a very 400, 500 million ARR and profitable entity potentially to finally list on NASDAQ. So our underwriting has always been, we want to provide a 4x gross, 3x plus net, 25 to 30% IRR. That's what we're underwriting, but mostly through secondaries, because we're a 7-year fund, not a 10-year fund. So the invest and harvest cycle for us, so we want to be able to invest and harvest in 5, 6, 7 years max. And therefore, from a US standpoint, given that the public markets are shut, it's again likely going to be either secondaries or potentially M&A, because M&A is quite robust, especially in, let's say, the sub 500 million category. In India, again, one can argue whether it's chance or it's skill. I would err on the side of, the market is what the market is. So when the sun is shining, you make hay, right? And that's precisely what our companies are doing by going public. So from an exit scenario planning standpoint, the underwriting was primarily through secondaries, but just the way it has turned out, India is yielding results through IPO. The US is still likely going to be a combination of M&A and secondary exits for us.
Got it. I'm conscious of time. The clock keeps ticking away mercilessly. So I'm going to try and move this a notch. Naren, I'm going to combine 2 questions. One is, say we have another 20% drop in the mid cap and small cap, extreme volatility, IPO market shuts down. How does this affect exit plans? And the second part is a common question I'm going to ask everyone. When you look back and reflect, is there anything you would have done differently given where you are now as far as the timing, planning, choosing of your exits of your portfolio is concerned?
So I'll give you quick answers given the merciless time. So, if the market drops 20%, that's business as usual. I think the market's been quite high. Markets will go up and down. I think if you build good, strong companies, robust companies of a certain size and scale, maybe under very negative, extreme periods, you will not be able to go IPO. I call that the window is shut. But most times, if you build solid companies, you will be able to go out at a reasonable price. So whenever you're going IPO, you have to remember that you are giving one hand and half a leg, because when the funds come in to invest, they want an attractive price. So that's anyway there in the thinking. Anyway, when you model your exit, you shouldn't model the market values. You should model the price at which someone else is going to get into that security in size and scale. So we take a little bit of a haircut there. So nothing really changes. Maybe if it's very extreme, we'll not go IPO. 2 more companies of ours are lined up for IPO, Veritas, SK. So maybe then we'll take a little longer to go IPO, maybe we'll wait 2 quarters. But good companies at $1 billion plus, they will go IPO. So the minute that sort of solves, we'll go IPO and we'll be reasonable about the valuation. On your second question, it's a very simple answer. I think we like the playbook we're in. We've had a phenomenal number of exits, and so I just wish we had sort of moved to that playbook. You know, we did that in 2017. I wish we had done that in 2010 or 11. I've been doing this for 17 years, so I wish I was a little faster in figuring it out.
Great, great, thanks so much. You know, statistically, it has been seen that bear markets, and you look at bull markets, in India at least, bull market timelines last 5 times more than bear markets. They come bear markets very deep, but then things start looking up. So focus on the quality and hang on in there, right? And the right time to exit will come. Visa, my question to you is again, you know, the common question that I thought, you know, anything you think you would have done differently had you had a chance to do it, given what you know now, given where the markets are now, given what you have experienced as far as your portfolio is concerned, any reflections you can share with us?
Yeah. So we've had a tremendous learning between Fund 1 and Fund 2, right? In Fund 1, we clearly don't want to repeat some of the aspects which we could have easily avoided. Like, for example, not planning for an exit in time and building for a failed process. You know, we've had instances while we've had, out of our 9 investments in Fund 1, we've got 7 exits. I think we could have done better by planning that the process can fail, right? So we've had, especially in one particular instance, we've had, at least before we finally got a successful exit, we had to go through more than 3 failed attempts, where it could have been a valuation gap, it could have been a rights issue, it could have been, you know, where the entrepreneur is having some different expectations. So I think you have to build adequate time into your exit process. And this could be as much as 2 years ahead of your stated exit timeline, right? So where this, you know, we generally invest with a 5 to 6 year kind of an outlook. So clearly, I think from year 3, you know, while in the initial 3-4 years, you can take a call, yes, margins could potentially dip, you work on growth for the first 3 years, and then you work on consolidating at an EBITDA level the next 2 to 3 years. I think we need to take a call on how the company is pivoting, and is it reaching at least 75-80% of your expected outcome that you want at the time of exit, and then start the exit process well in advance. I cannot underestimate the implication of that. And more important, and the second most important thing is engage with as many stakeholders as possible in the ecosystem to try and see how, you know, right from year 1, year 2, ensure that the entrepreneurs are well known within the ecosystem, right? They're meeting bankers, they're meeting potential investors, and this is something which we have consciously done right from year 2 of our investment. So these are the 2 things.
Great, thanks for sharing. Uday, any chance you can share with us anything you would have done differently if you get a chance to do so?
So, you know, I would say as investors, we are pretty paranoid investors. I'm talking about us, Afoma. And my only learning is we need to be more paranoid, right? Because you always need to have a plan B, plan C, plan D. Something always goes wrong. And you get into this motion of, no, everybody starts thinking it's going to happen, it's going to be great, and something will go wrong. And every time you learn, and every time you make the same mistake again. So I think this has been a learning. And you know, what is hard is, I'll tell you, and I think we've done a good job of it, is when you're underwriting a investment, you think 12 times EBITDA is a good multiple. When you're going, let's say for an IPO, let's say it's trading at 20 times EBITDA, and the team starts saying, oh, but I'm at a discount to the next comp, which is at trading at 30 times or 40 times EBITDA. And you have to keep your head together. I don't care what the comp is at. The absolute multiple is what I care about, right? So when it comes to entry, we have to be paranoid about, sometimes you have to just ignore what the comps are. It doesn't make sense. And it works both ways. It could be trading at half the price that your absolute value is, right? So it's more about that conviction and keeping that balance.
Yeah. And when you're talking about public market exits or exiting public market positions, it's so brutal because there is no hiding. It is what it is. And then it's essentially the strength of your own conviction which allows you to press the button on saying, okay, I'm going to exit more than what I had planned because the multiple's so great. Or in the inverse, I'm going to hold on to this position because the market is overcompensating on the downside. And Srinath, your thoughts, because you've, in your fund too, over this extended period of time, have had some great exits via IPO. And then, there have been situations where things have not gone as per plan, which you shared. For example, that company you were talking about where, the manager was supposed to do an IPO, but things got delayed. So reflecting back, any things you can share with us on what you would have done differently? The principle of it in terms of how you approach the exits, the timing, the choice?
No, a few things. One is, I think, if you ask me what I could have done better or what I should have done, is to take more money off the table when it was available, right? Banking financial services is one sector, for example. It used to trade at 2 times price to book or more, right? Now it's half, for example. So should we have taken more money off the table then? But who knew? Because my peer said didn't even sell at that price. They thought it'll go up more, right? At least I sold some, correct? Now, so question I think is again, as Uday said, don't overanalyze what peers are trading at. They may be trading for different reasons, including a charismatic promoter who set such a high watermark for his stock that the world may fall, but his stock doesn't come down. And if you think you try to benchmark to that, it just doesn't work. So when you can take money off the table, the IRR clock is ticking harder than this clock here, right? So you need to take money off the table. The second thing, if you ask me what I could have done or what I would have liked to have done is, many of us all of us are perennial optimists, right? The promoter is super optimist, we are also optimists. And we have super belief in our skills, investing skills, exit skills, whatever. I think I would say that if you're coming towards the end of your availability period, try to run as hard as possible in the availability period. We all have extension time available in the availability period. Sometimes we extend and invest more. If I go back and look at it, if I had not done it, I think I would have looked even better then. Our fund would have looked better than what it looks today, because then the clock is ticking. You're trying to see what the industry is doing. Industry keeps changing every 3-4 years. There are new investment ideas coming. Tech boom happened. It was crazy in 21-20 during COVID time. You thought markets will not get up for a while, and it was the craziest time. The IT companies were losing people right, left, and center. It was a totally different orbit of time that you cannot believe happened, right? So I think if I go back, then the discipline that let's keep our head together, and in the investment period, what we do the best deals and stick there and stick with fundamental companies. I think we'll come out better. I would think that would be my takeaway.
Mohanjit, any thoughts you want to share, given a long career in investing, exits, lessons, anything you want to share with us?
No, we got it perfectly right the first time around. So I wouldn't change a thing. No, seriously. Look, 2 things I'll say, so bear with me. An entrepreneur's ride, and we haven't talked about entrepreneurs as much at the Enclave for the last couple of days. If you look at typical, and I did this exercise last night, we looked at our own portfolio, again, of these 14 active companies. On average, these companies have been around for 10 or 11 years, right? We tend to celebrate these fantastic Zeptos and even Cure Foods within our own portfolio, going from 0 to 100 million or a billion or whatever it is in 3-4 years. But the reality is, it's a long-term game, right? So as a result, if you're focused on DPI, you have to keep that in mind. So the lesson that we have learned is keeping in mind the fact that it's a long journey, And in our case, we added both more capital and a ton of value after our original sort of initial investments in our previous funds when we were doing earlier, slightly earlier stage investing. We have pivoted or morphed our overall thesis to invest in these companies that are further down the path to this sort of 20 million ARR and beyond. So that has been a fundamental sort of focus on DPI, focus on when the capital is there, take it off, right? Don't hold on for forever and ever. Having said that, there are some LPs who are pushing us saying, hey, do CVs, do continuation vehicles. If you truly believe in something for 10, 20 years, figure out a way to hold on. So we're going through that exercise right now. But overall, I would say, just looking at companies that are further de-risked, and given that we're a 7-year fund, we have to look at that exit in a 5, 6, no more than 7-year time horizon. So that has shifted our focus in terms of which kind of companies and what stage of the company we invest in.
Great, thank you so much. So, ladies and gentlemen, we are out of time. I would like to ask the organizers, do we have time to take questions from the audience? Do we have time to take questions from the audience, Mr. Tandon? Somebody get this? Okay, I get the message. We don't have time. I guess we'll have to catch hold of the panelists. They have been extremely gracious and generous with sharing their experiences and wisdom with us. Please give them a big round of thanks. Thank you.